Good afternoon. My name is Seth Larner. Thank you for joining us here on our Webisode that Compass provides on a quarterly basis. I'm here today with Richard Hirschen, Jim Donellon, and Ryan Arpey from Compass. Rich and Jim are from Gray & Gray, two auditors that we work very closely with. And today what we really want to do was talk to you about 401k audits and what happens during them, and the whole process about it. With audits, they can get very complicated sometimes, but don't worry, we have Rich and Jim here who are very nice and very kind that help us through the process. Yeah. There's a number of different types of audits out there, but Rich, do you want to kind of talk about some of the audits and some of the scary ones versus not so scary ones?
Yeah, sure. Thanks, Seth, and thanks for having us. But a lot of times people hear the term audit and they picture this mean IRS agent coming and ask for all these receipts and digging in everything and all that. What we're doing is an audit of a financial statement of a company, or in this case for a 401k plan, and we are hired by that company. So you choose us. I like to think of us, we're the friendly auditors. We're coming in, we're trying to help you get that audit done, working with you, pointing out some things as we go along. So yeah, and we're doing it because you have to do it because of the 5,500 requires it. So I think, Ryan, you want to talk a little bit about that?
Yeah, that's right. Yeah, so basically why are audits required is what we're getting into. And basically, they're required by law to protect plan participants. They want to make sure that these employers are running their retirement plans accordingly to the DOL and IRS regulations. So all plans aren't audited, retirement plans. We're talking specifically about large plan filers, which are plans that usually are generally over 100 participants, and they're required to file this long form 5,500. When I say generally over 100 participants, because there's an 80-20 rule in place. Now this rule can get confusing. So basically, if you're if you're ready to open your retirement plan your first initial year and you are over 100 participants, you will be required for an audit in that first year. Now with the 80-20 rule is for, say, the next year in place. If you open up and initially open up your retirement plan and you have under 100 participants, you don't necessarily need an audit that year. So basically the 80-20 rule is for years after that, where if you are under 100 in the prior year filing, you don't have to file a large form, or there's no audit required. So basically it gives you this 80 to 120 window. So if you reach 121 participants on the first day of a year, that's when the participant count is is based off of. Then you will be required for an audit that year. So to get into eligible participants, how do we determine this participant count? Basically, it is all active participants throughout the year. Participants meaning eligible participants. They met the plan requirements. It also, not only if they're active, but if they're terminated and met the eligibility requirements, then they count as well. And also terminated participants with account balances also are included in this count. Plan counts are important, and Compass will let you know when the plan count gets close to 100 or 120, and we'll let the client know, hey, it might be time for an audit, and that's when we reach out to a firm like Gray & Gray, or we'll have the client communicate with external auditors to confirm which auditor they want, to get an engagement letter, and so on and so forth. So that's how we move forward with that. If you guys want to take over and talk more about that as well.
Yeah. One of the big things that maybe, Jim, you could talk about is there's multiple different types of audits, right?
Right, exactly. So in the financial statement audit world, there's really two different types of audits. There's one that's referred to as a full scope, and in a full scope audit, we're actually auditing the investments themselves. A vast majority of the plans we audit do not go down this route. It's not something I would recommend unless it's required. Typically, if a plan needs a full scope, they are a public company, they have stock in the plan, so they don't have a choice in the matter. They have to go through a full scope audit. Other situations, if there's, let's skip to the limited scope. So it used to be called a limited scope. The rules have changed recently, so anybody that's filed a plan for this past year, you've already gone through this. It's referred to as a 103A3C.
Say that 10 times fast.
So we're not very creative in this field sometimes, so I'm hoping a nice nickname comes in sooner rather than later. But in what I'll refer to as a limited scope to keep it easier, there's a trustee or custodian that certifies the completeness and accuracy of the investments. So a vast majority of the 401k plans we see, they have a custodian they can rely on. That certification is provided to plan management and the auditor, and that greatly reduces the amount of audit work that needs to be done around the investments.
And that's what, like the record keeper? Is that more?
So it's really more the custodian
Yeah.
of the assets. So it's a bank or a trust company or an insurance company are typically the only qualified institutions to give this certification.
Seth, can I just point out something, right? We were talking about when you need to audit. So while I think we're great and a lot of people enjoy having us around, some people try to avoid the audit. And one of the things that companies can do, most plans have the automatic kick-out provision where if they have less than 5,000, you just kick them out of the plan. And that's something we encourage people if they're getting near that 100 or 120 limit to look at that and maybe make those moves, get those people out of the plan to keep the count down, and sometimes they can push off the audit another year or two.
Yeah, that's a great point, Rich. That's something we do all the time. So what we always want to do is usually fall, we start September-ish time frame. We always look at every plan and make sure, hey, can we push anyone out of the plan to get them under that, bring them down below. If they were in an audit, get them below it. You know what I mean? Go between 100 and below 100.
Under 100, yep.
Or if they're at the 120, they haven't never had an audit, can we keep them under 120 so they avoid it? So it's a great point that we can try to play with some things to make them under it.
It's also good practice just to get
Yes.
people out of there if they don't
Small
need to be there
count
anymore.
balances force outs, exactly. With that being said though, getting back to what Jim was talking about, just about the audit process, when you guys start going through the process, what are some things that you kind of look at from the very beginning? From clients and all that, and maybe even talk about the first year audit, because I know that sometimes can be a little bit more hectic for clients because it's just not year one you're testing, you may be testing back a few years. So.
Right, exactly. So once you get the good news that you require an audit, that's when the auditors come in. And really, our focus is on compliance with the plan document. So we're looking, what are the eligibility requirements? Is that being met? Does the plan have auto enrollment? And if so, is it being consistently followed appropriately? For contributions, we look to make sure that whatever is being withheld is what the participant elected to have withheld, and that it's getting into the plan timely. That's one of the rules, and I think we'll get to that a little bit later. But the timeliness of contributions is important. Loans, distributions, we make sure that they're being authorized appropriately, that they're in line with the plan document. And Seth, to your point about first-year audits, so if the plan had been around for a number of years and it hadn't hit that threshold yet to need an audit, we do need to go back in time, and there's some judgment involved. If the plan came around in 1975, we will not go back to 1975. There's some materiality in keeping common sense in mind. But in the first year, we need to get an understanding of the internal controls with the plan, understanding who's who at the company, going back and testing balances over the last few years. So there's a lot of work that happens in year one. The good news is after you go through it once, a lot of that builds a nice foundation. So going into year two, there's a lot less stress on plan management. The auditor still has a lot to go through, but plan management is a lot easier.
With that, another question that came to mind is, what about if you take over an audit for another auditing firm? So let's say another auditing firm, no longer is around, or something happened, and you guys got hired in. Is there anything you have to do with that by chance, or is that just you pick up, or do you have to review old work?
So there is a requirement to at least attempt to review the predecessor auditor's work papers. Generally speaking, in our industry, it's very common, and most firms collaborate and work together to make that an easy transition. If in the new auditor's view that the work was done was done appropriately, then you can rely on the work done by the predecessor. If we feel they didn't do the work they should have done, then we do have to open up the past couple of years and do a little bit more work, almost similar to if the plan had never been audited before.
Yeah, similar to when we take over clients as well. We need a lot of prior information, and it's important. So,
So great. As we're going through some of this too, by the way, if any clients that are listening have questions, by all means, you can submit them to the thing, and we'll answer all the questions at the end as well. So just want to send a little reminder out there. Now, Rich, one question I have for you, just out of curiosity, is doing all the audits you guys have done, what are some of the most common errors you see in plans that sometimes cause the audits maybe not to go as smooth as they could?
Yeah, there's a handful that come up every year. I think the most popular one in the last year is eligible compensation issues. A lot of plans, and you really have to look at the plan document to see what is specified as a plan compensation, but things like bonuses, commissions, that sort of stuff
Them being
trips up.
excluding
Sometimes
bonuses,
they're excluded,
right.
sometimes they're included.
Yeah.
And you see it both ways. Some plans have the participant can elect whether they want withholdings on that bonus
special
or
election,
not.
yeah.
So, it's really looking at that, understanding your particular plan and making sure that it's set up the right way. And we always encourage clients, like look at the payroll accumulator codes that you're using there and make sure they're set up and they match the plan document. But it's a good idea just to look at that plan document a couple times, make sure you're familiar with it if there's any amendments or things like that. But we see that a lot.
One thing that I see a lot too that happens is sometimes they add a payroll code.
Yes.
So quite often everything's running smooth, and then one year they add a payroll code, and maybe it's an additional fringe benefit. I mean, fringe is a very controversial thing. And they add it in. Next thing you know, 401k deductions are coming in when they shouldn't be. So always make sure, if you're a plan sponsor listening, if you're adding any payroll codes, review the plan document. Speak to either Greg or Compass, and we can help you with that.
Yeah, and just review it periodically to make sure that there weren't new codes added that got missed.
Very true.
Which is so what happens if you're wrong on that and you find you made a mistake? I mean, our advice is just be open about it, right? We're all here to fix it, and it's not like, oh, don't tell the auditor, don't tell Seth and the guys at Compass. Come forward. We're going to find it anyways when we do the audit, and it's so much easier when it's found ahead of time. There's all kinds of correction programs, and it's really not a big deal. At the end of the day, we all just want to, including the DOL, just wants to get it right.
Right.
And to your point too, with the correction programs, the great thing about qualified plans, which is a 401k plan, the audit, is there's always a correction program. There's actually a book out there called the 401k Fix It Guide, which the IRS creates.
About our industry.
So we're there to help
you
and
can
fix.
correct it.
Popular book.
Exactly. Now, if you had like a non-qualified plan, which I don't want to get too much into this, there is no correction methods for those. So those are a little bit different. But for the qualified plan work that we're all in right now, there is corrections always for that. So.
Some other things that come up, late payments, that hasn't been as much in recent years. I think the DOL has done a good job cracking down on that. But for a large plan, one that would require the audit, there's no safe harbor of you just have to do it in 7 days. The rule is do it as soon as administratively possible, but no later than the 15th business day of the month following the date they were withheld. But it really means do it as soon as you can. And in different seminars and trainings I've been to when the DOL has spoken, what they've said is, look, if you can do your payroll taxes in 1 day, why can't you do your 401k withholdings? And when we go in the audit, we look at what's typical. If you've shown over and over again that you can get that money segregated and paid into the plan within 2 days, really anything outside of that window, we're going to be like, how come it was late? And sometimes there's valid reasons, which we always suggest to our client, when that happens during the year, if something happened, it caused you to be a few days later than normal, document why.
And reach out to Compass as well, because that's when we're here to take over. We calculate lost earnings and we correct the late deposits.
That's right. And then the last one we see a lot has to do with auto enrollment, of just, when companies do the auto enrollment, that's a great thing to get participation up, get employees saving for retirement, but administratively it can be more difficult because now you're responsible as a plan administrator for making sure that people got enrolled. Versus if you don't have auto enrollment, it's on them.
Even more important to know the plan document and the eligibility requirements and the difference between when you're eligible and the actual date of participation, whether it's monthly, quarterly, semi-annually. There's the participation entry date is the big one too.
And sometimes when it gets in, you need a certain number of hours, and maybe as soon as you trip those hours, you can get it. So it's not always on month-end dates. It can be kind of weird. And so we always suggest, like you said, know your plan document and what your rules are, but have the systems in place to make it all automated. When that's not automated, it rarely works well.
And speaking with the auto enrollment, the other issue that I see quite often is auto escalation. So clients that have auto enrollment start at, let's say, 6%, and then say, we're going to increase every year by 1% to 10 or 15, you can go now. You really have to have, to what you're saying, Rich, good processes in place, because if the auto escalation starts going and you're not increasing it, that's just as big of a failure. So that's something to be aware of as well. So,
like I said, they're great tools to encourage participation, but they require a little more work on the plan administrator side of things to make sure it's done properly.
And then one other thing that just have a question on is timing of audits. So when you guys are going through and all that, when do you guys like to get audits done? I feel like a lot of people say, well, why is it getting done on October 15th? And I know it's not you guys, but like just curiosity, just like, when do you guys like to get audits done? Do you guys create a timeline? Just some stuff like that to help maybe some new listeners that are maybe going to be going to their first audit in 2023. You know what I mean? So
the way our firm operates, and I'll speak to calendar year plans because the vast majority of the ones we audit are calendar year. So the due date is the end of July for calendar year plan, but it can be extended 2.5 months to October 15th. To your point, Seth, a strange number get done in October. We'd like to avoid that. So we start the process in May. That's usually, generally speaking, when all the year-end reporting is getting done, compliance testing is done, so our work can begin. And we work around client schedules. Some might be away for the summer or something going on with vacations, and we can work around that. I would say, comfortably speaking, the audit process start to finish is somewhere in a 4 to 8 week range. And I don't mean that people are working every day for 4 to 8 weeks. It's just us getting through our requests, getting from third parties, and it coming back, and us going through, reviewing, and whatnot. So we always encourage to start that process and at least map out the timeline that everybody can stick to. It doesn't mean everybody has to start in May. If you want to finish an issue in September, let's at least have the conversation now and map out how that's going to look.
Great. Awesome. Just one last thing, and again, one more thing. If you have any questions, please type them in the chat. We'll be answering those questions shortly. But last question. There's probably some people thinking, well, how do I pick a qualified auditor? What do I need to do? So I wasn't sure, if you guys had any things off the top of your mind. I know for me, one thing I've heard from the DOL and IRS is making sure you pick an auditor that has auditing a number of plans.
Yeah. So the benefit plan audits, there's accounting firms, we all do audits of companies and things like that. A 401k plan audit is different, and you need some specific experience in order to do those. DOL has done a lot of studies on audit quality, and they found that the audit firms that just do a handful of these always have issues with their audits. So you want to pick a firm that has experience that does a bunch of these. And you can look that up. There's free Google searches, and you look at 5,500 filings, you can see how many they do. But if I were looking at that or suggesting to someone, make sure they have good audit plan experience. Make sure their approach matches how you operate. We have a nice organized approach. We lay it out. We have a kickoff call and kind of go through the whole thing and get together timelines and are very organized. So just get to know the accounting firm, make sure they're a good fit. Any accounting firm that does benefit plan audits needs to be peer reviewed. So you might want to ask for their latest peer review report.
Can you go into that peer review of just, is it another auditing firm, or just is it,
Yeah, so audit firms, under the audit standards in the US, we have to hire another firm to come in and audit us to make sure that we're doing our jobs as an auditor. And so that's done every 3 years. And so that firm comes in, they test all of our systems, they look at a sample of files and do this whole thing, and they issue a report. And it's really pass-fail. Either you pass the peer review or you don't pass. So you want to make sure you pick a firm that has passed the peer review. And then the final thing, the AICPA, the American Institute of Certified Public Accountants, has a employee benefit plan audit quality center that firms can voluntarily apply to and be a part of. If you're a member of that firm, there's certain CPE requirements we have to have that are specific to benefit plans. Yeah. So it's just another indication that a firm is taking it seriously and doing everything they can to be experts in this area.
Oh, great. Okay. Great. Well, with that, that's about the last of it. We have some questions coming up that I think are kind of important. I'm seeing come through, and just that would be good to go through it. First is what kind of materials will you need from us for the audit? So that's I think a great question.
That is a good question. I could start off actually, with a third-party administrator like Compass. We obviously work with auditors often during these retirement plan audits. And one of the big things that Compass or third-party administrators do is work with your investment company or record keeper. And we have distribution forms on file because auditors are going to ask for enrollment forms, distribution forms, backup information for a hardship distribution. A lot of the backup information that Compass has on file, whether it's, since we approve and review the distributions and stuff like that. So it's important to reach out to Compass, in the beginning as well. So,
what about you guys? I mean, some of the stuff that you guys are going to request for the audit.
Yeah. So from our standpoint, we'd be looking at the same materials that Compass would have access to. We really kick things off by getting payroll reports from the plan management, and also getting what's referred to as the audit package. So the custodian of the assets would have a package put together that gives all the information of the ins and outs of the plans throughout the year. But otherwise, from a plan management standpoint, it's things like I-9 forms to prove out dates of hire and dates of termination, and really think of it of payroll and your HR file for people. Those are probably the two primary things that we'd need access to.
Okay, great. And we work really well with Gregory and Gray just to make sure that they get the stuff. So usually what happens is when the audit request list comes out, just in general, they'll have maybe 20, 30 things on there. and we'll actually highlight, here's things that Compass will handle, and here's things you as the plan sponsor need to handle, and then here are things that are going to come from the record keeper where your money's held. So we'll kind of help itemize those out. And then one thing I always like to do, and I know Jim and Rich and Ryan all do the same thing, is put due dates on it. That way we all are held accountable to make sure it gets done timely.
Yeah.
So.
Yeah, I mean, as Jim said, a typical audit, I say like a non-stressful audit where no one's working weekends and everything to get it done, takes 4 to 8 weeks. That can take 4 to 8 months if, no one, in order to do the audit, we need certain things. And so we're waiting for those. So we always take that approach. Let's go down the list. Let's all be accountable. Let's determine when we're going to do things. And if you do that, everything goes very smoothly.
Yeah, perfect. It looks like we have some additional questions too. One is we have a lot of terminated employees with balances still left in our plan. Do they count towards the audit, or can we ignore them? I wish you could ignore them.
Yes,
Yeah.
yes, they count towards the audit. We did mention this a little earlier as well. We have a couple of different options. One option is mandatory cash outs or force outs, which can help lower your participant count numbers. But yeah, they do count terminated employees, and at the end of every year, Compass, we work on trying to pay these participants out to try to get those numbers down. If your account balance is under 5,000, we can usually force them out of the plan. So.
Yeah. The next question, and I'll let Richard Jim answer this one, but what happens if our plan grows to more than 120 participants during the year? Do we need an audit for the full year?
So the count goes at the beginning of the year.
As a
so
1-1, if you're a calendar, right?
Yeah, 1-1. So if it happens during the year, you get to wait until the next year.
Yep.
Yeah. And another thing about that, remember, so in beginning of 2023 is when they'll start auditing 2022 plans.
Right.
Yes, the 2022, the 12/31/22 year end,
Correct.
we'll be doing May through October of 2023.
Both of our, we all work a year behind, basically.
Yeah,
Yep.
that's right. We're always looking in the past.
Yeah.
Exactly. Hindsight's 20/20,
Yeah,
they say.
so that's right.
But with that being said, that comes to the end. Looks like there's a few more questions, but we can circle back with people on that. But first of all, I just want to thank Jim and Rich for joining us from Gregory & Gray. It was a pleasure having you guys here with us. They're a great auditing firm right outside of Boston. And Ryan, thanks for coming down.
Thanks for having me. Appreciate it.
Yeah. If you have, please stay tuned. We'll be doing another one at probably another couple months. We're trying to do these on a quarterly basis. I hope to be the host. If not, Chris will join you. One of us will be here. So thank you all, and have a great day.
Thanks.
Thank you.
Thanks.